And now we will have a very interesting keynote about the OXO journey from the Treasury across venture capital onto the Parquet by Péter Oszkó, OXO Technologies Holding, who is a founder and managing partner of a listed European tech investor group, a previous finance minister of Hungary, and the Big Four managing partner. Peter, the floor is yours.
Thank you very much, ladies and gentlemen. Thank you for the invitation. When I get this invitation, I've seen in the program that I am the last presenter before the last coffee break. I knew that this is a risky position, but we are VC investors, so we are used to take risks. But this is why I knew at the beginning that I should do a very quick presentation in order to keep your attention alive. That's what I will do. So I won't bother you with a very long story of our journey, although it's almost 10 years now that we have started to build up our company group. But I will only focus on the main stages and on the lessons that we've learned. First stage was, of course, the starting early stage investments, and I'm the typical angel investor who starts the first investments on his own. And that's the same experience as many other investors and even startups can gather, that at the beginning you make your first mistakes, actually. So I invested very emotionally. I was connected very personally to the targets. I made many emotional decisions, and I lost my first investments very quickly, which is a good point because it means that I learned my first lessons on my own cost. So I didn't lose the money of other investors, but I lost my own money, actually. And that's a good point if you can learn very quickly, because then when you launch your first fund already, and you became responsible for the funding of others as well, then you don't commit the same mistake again. But the lesson we've learned that it's very difficult to make money with early stage investments. And I think many of you have learned that lesson already. I didn't give you too many statistics in my presentation, but I will give you one because I am still a man of numbers. PitchBook recently published a study, statistics about more than 7,000 pre-seed and seed early stage investments. They collected the data between 2010 and 2016. More than 7,000 early stage investment in that period. 50% of them didn't receive any further funding. 30% of them are already under liquidation. There was 13% of exits, although, as I said, this is early stage investments between 2010 and 2016, and we are now already in 2023. Only 13% exits, and a further 4% are still existing, and they get further funding rounds, so they still have a hope to exit at a certain stage. But it means that from that quite representative numbers, less than 18% survived from early stage investments. That's a very high failure rate, actually. And this is why we still believe that early stage is a very risky stage of investing. And we also experienced at that stage that only those earn a lot who invest at the last rounds. You know the logic of the liquidation preference and the logic of the whole VC investments. If you want to be part of the profit sharing, you need to be part of various funding rounds. This is why the most important lesson I have learned, and we learned, that we should do it together with others. Early stage investing is not something you should do on your own, or you can do it, but then it becomes a hobby. If you can do it with others, if you can form common structures, if you can share risk, then it becomes a sustainable business as well. So we launched our first angel fund after the first experiences, which was a quite successful fund. We could create, we could achieve quite spectacular returns. We closed that fund after 5 years, and we closed it at a 4x return. Even these were quite good periods It means that the funding was very cheap. It was much easier to find exit opportunities, but still it was quite attractive for the investors. Also, again, the lessons we've learned. Lesson we learned that the profit is from growth in value and not from simple valuation. So we don't care whether we create unicorns or not. The question is at what value we invested, whether the company used the funds efficiently and they could create real growth from using the funds. If yes, then you can make return. If not, then the valuation is irrelevant. And even more, what we've learned, that more funding we have, easier is to participate in later rounds, and we can increase exponentially on our return. This is why we could have such an attractive return, because it was not only the early stage that we invested in, but we could do follow-on rounds with other investors as well. On the reputation of that angel fund, we could already attract institutional investors, which is, I think, a quite good achievement in this region. Under institutional investors, I mean insurance companies, banks, asset managers from the market. I'm not talking about public funds. So we were among the first who could create fund structures involving institutional money, market players. But that also creates a pressure on you, because the institutional investors are not the fan of simple early stage investments. So within institutional money, you try to make balanced portfolios, balanced risk profile. And already about 5 years ago, this is why we entered the market of later stage investments. And not simply later rounds, but we started to do secondaries, which was quite new at that time. And we started to do buyouts as well. And to be honest, if I look at back the last 3-4 years, the most attractive exit we made from secondaries, actually. So that we have learned that type of business, which is very typical to the Western markets, but still pretty new to our market, is a very good opportunity to make money and to balance your early stage, to balance the risk of your early stage portfolio. As you understand from the story, perhaps the main characteristic of our company group is that we bring private money to the ecosystem from outside the ecosystem. There are a lot of enthusiastic startup investors, fortunately in Hungary, who made their money from startup businesses and they reinvest. And this is a must, otherwise we cannot build up the ecosystem. And there is a lot of public funding, which is also a must, because savings are at a quite low level still in this region. But what is also necessary, I think, is to be able to attract other type of private savings to build up that ecosystem, because without that, there will be no market logic, there will be no attraction for market investors. And this is what we do. This is our forte, actually. We could convince angel investors, general business investors to use a part of their money and invest into startups, and we could also convince institutional investors. And on that basis, it was quite logical that we concluded that we go public. We try to list our company. We try to present it to a wider range of institutional and private investors, and we try to create a structure which is not beneficial only for us, but which can be used later by attractive startups or even similar investors to us. Unfortunately, it's happening. So what we see now, that the structure we've created is becoming more and more popular, and more companies are using this. And our last stage, which is still not closed, so it's more happening now, that what we've decided that if we want to create successful funds that are able to compete in the real league, then we have to go international. This game is not played locally. You cannot build up startups locally. You have to do it internationally. And even if we want to attract professional private investors to our ecosystem, we cannot do it only in Hungary. If our reputation is that we can attract Hungarian investors only, that we don't do the job properly. If we have attractive returns, then it's attractive for everybody. Why not to try sell ourselves to foreign family offices? And that's what we are doing now, or we have done already. We had some funding rounds successfully already outside of Hungary. But this is why we create our operating structure internationally. We have opened offices in the Netherlands. We are widening activities. Even the portfolio is much more international than before. But I would say a significant part of our investors already outside of Hungary, and this is the way we want to grow further. I hope that we are only in the middle of that journey, and when I come back some years later, I will be able to tell you the second part as well. So see you then. Thank you very much. Thank you for your attention.